Here's a stat that should scare you. 63% of homeowners are underinsured. And when disaster strikes, a house fire, a major accident, a lawsuit, they discover their coverage maxes out far below what they actually need. One family in Texas lost their home in a wildfire in 2022. Their policy said $400,000 coverage. The rebuild cost $680,000. They had to pay $280,000 out of pocket. That's a financial catastrophe that could have been prevented. But here's the good news. Most of these insurance mistakes are fixable. In the next 12 minutes, I'm going to show you the 5 costliest errors families make and exactly how to plug these gaps. We're talking about real money here, potentially $2,000 to $10,000 per year in unnecessary losses. If you've never audited your insurance, this video could be the most valuable 12 minutes you spend this month. Let's start with the biggest one, underinsuring your home. Here's how this happens. Most people insure their home based on the mortgage amount. That's fundamentally wrong. Your insurance shouldn't cover what the bank says. It should cover what it costs to rebuild from scratch. Those are completely different numbers. In most markets, rebuild costs are 20 to 40% higher than what homes sell for. Why? Because the sales price includes land value. Insurance only covers the structure. A home worth $400,000 might cost $580,000 to rebuild. The second problem is inflation. Rebuild costs have increased 8 to 12% annually over the past 3 years. But most people's policies haven't updated. That policy you set 5 years ago? It's significantly under coverage now. Here's the action. Get a professional rebuild estimate. Don't use online calculators. Call 3 contractors and ask, how much would it cost to rebuild this house from the foundation up? Factor in labor, materials, permits, and inflation. Then add 10 to 15% for contingencies. This number, not your home's sale price, is your coverage floor. If your current policy is below this, call your agent today. Most companies will increase coverage for just $10 to $20 extra per month. For many families, that's a $50,000 gap closed for less than $200 a year. Most people set their insurance once and never touch it again. That's the second massive mistake. Life changes. Your income changes. Your assets change. Your liabilities change. But your policy? It sits there frozen in time. Here's what actually happens when you ignore reviews. Rates spike without your notice. Coverage limits become inadequate as you accumulate more assets. Discounts expire because you don't know they exist. Life changes that qualify you for better rates never get applied. I had a client, let's call him Mark, who got the same homeowner's quote every year and just renewed. He did this for 8 years. When we finally reviewed his policy, we found he qualified for 3 discounts he'd never activated. A smart home security system discount, 7% savings, bundling his auto policy, 10% savings, and a loyalty discount he'd aged into, 5% savings. Those 3 combined, $1,847 per year. He'd been overpaying by nearly $15,000 over 8 years. The fix is simple. Annual policy audit. Mark your calendar. Once a year, I recommend during your birthday month or New Year, pull out every insurance document. Check 3 things. 1, have your assets or liabilities changed? New car, inheritance, new business, remodeling. 2, have you made home improvements that reduce risk? New roof, updated electrical, better security? 3, what discounts exist that you don't have? Then call your agent and renegotiate. Even if you don't switch companies, this conversation takes 30 minutes and typically saves $500 to $1,500 annually. That's a $30 per minute return on your time. This one costs families thousands because it seems counterintuitive, but here's the truth. Your deductible is the single most powerful lever you control. Most people choose deductibles based on gut feeling. I'll take the $1,000 deductible because that sounds manageable. Wrong approach. Here's the math. A $500 deductible on homeowners insurance costs roughly $100 more per year than a $1,000 deductible. Over 10 years, that's $1,000 in extra premiums. But here's the critical piece. How many times do most homeowners file a claim? Research shows the average homeowner files a property claim once every 8 to 10 years. So statistically, you're paying $1,000 extra over a decade for one claim. That doesn't make sense. The smarter strategy is this. Choose a deductible you can actually afford to pay from an emergency fund, then pocket the savings in premium reductions. If you can comfortably cover a $2,500 deductible from savings, do it. You'll save $300 to $400 annually on homeowners. Over 10 years, that's $3,000 to $4,000 you keep. Even if you file one claim and pay the $2,500, you've broken even, and you've protected yourself for all the other years. Here's the trap people fall into: choosing a deductible they theoretically can't afford, which means they skip claims entirely. A client of mine had water damage, $4,000 in repairs. Her deductible was $500, which she could handle. But her homeowner's premium was sky high because she'd chosen too low deductibles. She paid extra premium for protection she wouldn't use. The strategy: make deductibles match your actual emergency fund capacity, maximize savings, and file claims when they make sense. Literally, everyone leaves money on the table here. Here's a hard truth: your standard homeowners and auto policies have legal liability caps. They're usually $100,000 to $300,000. That sounds like a lot. Until you understand what happens when someone gets seriously injured at your home or in your car, sues you, and wins a judgment for $2 million. Your policy covers the first $300,000. You're personally liable for the other $1.7 million. This isn't hypothetical. A guest slips on your icy driveway and breaks their spine. Surgical complications, permanent disability, lifetime care needed. Lawsuit judgment, $2.8 million. Your homeowner's covers $300,000. You owe $2.5 million. This is why umbrella insurance exists. It's essentially extra liability coverage that sits on top of your standard policies. And here's the shocking part: it's incredibly cheap. A $1 million umbrella policy costs $150 to $300 per year. A $2 million policy is $250 to $400 annually. That's the cost of 2 coffees per month to protect yourself from losing everything. But only 13% of American families have it. Why? Most people don't know it exists or assume it costs more. A family with a home worth $600,000, 2 cars, and some assets should absolutely have $1 to $2 million in umbrella coverage. The math: if you get sued beyond your standard coverage, you're personally on the hook for the difference. An umbrella policy means you're not. The action: call your insurance agent today and ask for a $1 million umbrella quote. I'll bet you'll be shocked at how affordable it is. Then ask, what do I need to do to qualify? Usually it's nothing complicated, just maintaining your standard policies. For under $25 per month, you've eliminated one of the biggest financial risks families face. This one is emotional and devastating when people get it wrong. Your beneficiaries on insurance policies, life insurance, health insurance, retirement accounts, they're essentially financial instructions you're leaving behind. Most people set them once and never update them. Then life happens: divorce, remarriage, kids born, estrangements. The beneficiary form is still pointing to an ex-spouse or a parent who passed away. Here's a real example. A man in his 40s had a $500,000 life insurance policy through his employer. He'd been married 25 years, but he got divorced, remarried, and had 2 kids with his new wife. He never updated the beneficiary. He died unexpectedly. His $500,000 policy went to his ex-wife per the original form. His current wife and 2 kids got nothing from that benefit. It was a legal nightmare and a financial catastrophe. The second problem is outdated designations. Maybe your adult child is listed as a beneficiary, but they have substance abuse issues and poor financial management. Do you really want that money going directly to them? Maybe your elderly parent is listed, but they are now in a nursing home, and you want the funds to protect their care. You can't change it if you're gone. Here's how to fix this today. First, gather all documents: life insurance policies, 401k statements, IRAs, even bank accounts. Many have beneficiary designations. Second, review each one. Is the person still in your life? Are they the right person? Third, make updates. This usually takes a phone call or online form. Fourth, and this is critical, tell your family or estate executor where these documents are. If your beneficiaries don't know they exist, they won't claim them. A $300,000 life insurance policy that nobody knew about is worthless. Fourth, consider a trust if you have significant assets or complex family situations. A trust lets you control how money is distributed, not just who gets it. The action: spend 1 hour this week auditing every beneficiary designation. Update the ones that are wrong. Tell your executor where these documents are. This 1 hour of work could save your family months of legal battles and tens of thousands in lost benefits. Let's do a quick audit right now. You don't need to fix everything today, but you need to know what's broken. Here's your action checklist. Grab a notepad or open your Notes app. First, home and auto insurance. What is your current coverage? Is it equal to replacement cost or just what you owe? Check this in the next 24 hours. Call your agent and ask, what would it cost to rebuild my home completely? Compare that to your policy limit. Gap? Write it down. Second, policy review timeline. When did you last review your insurance? If it's been more than 12 months, schedule a call with your agent this week. Not next month, this week. Third, deductibles. List your home deductible, auto deductible, health insurance deductible. Are these aligned with your emergency fund? If your deductibles total $5,000 but you only have $2,000 in emergency savings, you have a problem. Fourth, umbrella coverage. Do you have it? If not, get a quote today. If yes, is it $1 million or higher? Fifth, beneficiaries. Pull your last life insurance statement, 401k statement, and any IRA documents. Check beneficiary names. Are they current? Write down any that need updating. Then schedule 30 minutes this week to make the calls. These 5 minutes right now, writing down what needs fixing, might save your family tens of thousands. Don't skip this part. Here's what I want you to do in the next 48 hours. 1. Pick the easiest gap from our audit, probably the beneficiary update or the umbrella insurance quote. Do that today. It takes 15 minutes. 2. Schedule your annual policy review. Put it on your calendar for the same time next year so you never forget. 3. If you found a significant coverage gap like underinsured home value, contact your agent and get a new quote. Most increases cost less than $20 per month. Finally, share this video with someone else in your family. Insurance is boring, which is why families ignore it and lose money. One conversation with a spouse, a parent, or a sibling could help them avoid thousands in losses. Next week, we're talking about the biggest retirement savings mistake middle-class families make and how to recover from it even if you're already in your 50s. It's a game changer. If you found this valuable, hit that subscribe button and turn on notifications. Thanks for watching, and I'll see you next week.